Hey traders, this is Blake Morrow with Traders Summit, and with me today once again is Eric Basmajian from EPC Research. Eric, how are you? Good to see you.
Doing great, Blake. Thanks for having me on again.
It's my pleasure. It's really good to see you right now because I think you're the perfect person to break down some of the action that we're seeing in the markets. We're seeing bonds really move and yields are starting to fly around, but not across the entire curve. And so, I really wanted to get your input on how you felt about the bond market, how you feel about some of these moves, and how you feel about, stocks being at all-time highs. So I'm glad that you're here. What do you got for us today?
Sure. So I brought a couple of charts with me today to help kind of emphasize some of these points. I'm going to pop them
Fantastic.
up on the screen as I'm talking here. From the last couple of times that we were on, just to sort of backtrack a little bit, I talked about this growth slowdown that we were seeing. So if we break the economy into two parts, growth and inflation, we'll leave inflation to the side for a second. These are the four measures, or the four main measures of real economic growth. I call this the four corners of the economy. So you have production, employment, consumption, and income. These are all in real terms. And the inflection point was March of 2021. And you could see it across basically all four of these indicators. We had industrial production hit a peak, consumption hit a peak in growth rate terms, real income had hit a peak, and non-farm payrolls had hit a peak. And this is not a leading economic indicator. This is what we call coincident economic indicators, which means what's going on in the economy right now. This isn't going to give you an idea of where we're headed. This just gives you an idea of what's going on. And the good thing about following data like this is it's not an opinion. This is just what has actually happened. And I like to combine those four into one aggregate index, what I call a four-factor coincident index. And again, we can see that the economy accelerated out of COVID in real terms throughout 2020. It really jumped hard through the beginning of 2021. And then we had a major inflection and a reversal in terms of the growth rate. So now the growth rate is coming down. So why is that important? It's important because on the other end, we have some pretty severe supply chain issues going on, and they've actually worsened over the past couple of weeks in various sectors. So you have the growth rate in the economy coming down, but you have the inflation rate in the economy going up. And now this puts the Fed in a very difficult situation because the Fed is very worried about inflation. They can't do a whole lot about the supply side, but they're going to start to tighten policy anyway. So if I fast forward to what's going on in the yield curve, relating it to that growth and inflation data, on the top row, you see what I would consider the front end yield spreads, which are almost entirely controlled by the Federal Reserve, either through their policy rate or through their forward guidance. Okay. So you look at like the 2-year versus 3-month is jumping really, really hard. The 5-year versus 3-month and even 2s versus 5s has steepened materially since the summer. What those three spreads are telling you is that the Fed, or the market, is anticipating the Fed is going to tighten policy. In the next year or 2 years, we're going to start to raise rates. However, if you look at the bottom panel, these are what we'd consider more back-end yield spreads, which are less influenced by the Federal Reserve. They can't control the 30-year as much as they can the 2-year. And what we see there is a really, really material flattening. And the flattening has been accelerating over the past couple of days. And the reason that the flattening is occurring is because of that first chart that I showed. Ultimately, if I was to boil this down into one word, we have the Federal Reserve that's gearing up to tighten policy into slowing economic growth. And there's really no debate about the slowdown. It's empirical. We could see it in the data. The question is whether growth is going to reaccelerate or not. But what we have, if I was to boil it down, is we have the growth rate in the economy coming down. We have the Federal Reserve worried about inflation. They're guiding towards hiking policy, and that's causing the back end of the yield curve to start flattening. And the back end is what we would call bull flattening. So the 30-year rate is coming down as the curve is flattening, which is a very strong growth slowing signal, or a signal that the Federal Reserve may be gearing up to make a policy mistake here by tightening into a slowdown. And we had the GDP report come out today, and I'll kick it back to you, but we can go into some of that, which confirmed some of this growth slowdown.
Yeah, and Eric, I wanted to say the last time that we spoke, you talked about the possible policy errors that the Fed might be making. Well, here we have the market truly reflecting that. Yet, once again, here we are with the stock market at all-time highs. So it seems like a little bit of mixed messaging, or the market really is taking all this in stride. So what do you think here? I mean, if stocks are, if the Fed's going to make a policy error, or potentially could be making a policy error by raising rates or tightening monetary policy as growth is slowing, what do you do in the markets? I mean, stocks are at all-time highs. Do I just continue to hold them, or is this maybe one of those situations where, the Fed, or maybe the market, gets a little caught wrong-footed? What are your thoughts?
Right. I had a feeling that you were going to ask me about that, so I brought another chart for you on that topic. So what we see here is what I call the macro performance ratio. So in this chart is equities, bonds, gold, and commodities, sort of your four major asset classes. And the representation that I use for equities is IWM, or the Russell 2000. And the reason I use the Russell 2000 is because the S&P 500 is very much influenced by a handful of large technology stocks. And those technology stocks can act as a bond proxy in some sense. So when the yields on the long duration bonds fall, there's sort of a reflexive bid for these long duration equities. So I like to use the Russell 2000 because it's much more sensitive to organic economic growth. And if you look left, it shows the relationship or the relative performance between the Russell 2000 and EDV, which is your 25-year duration treasury bonds. So when the line is moving lower in this chart, that means that equities are underperforming bonds. And when the line is moving higher, that means that equities are outperforming bonds. So if we recall the first chart that I showed, the economy was accelerating through March of 2021. And I'm not sure if you could see my cursor here, but equities were outperforming bonds through the beginning of the year.
Yes.
Since that inflection in growth, we've had a material underperformance of stocks relative to bonds when you measure it with the Russell 2000. So the stock market, measured as the Russell 2000, hasn't actually outperformed bonds in a relative sense since about February, which is consistent with a growth slowdown. Now, if you look at the equity market, we're starting to see the defensive sectors, which would be like your large cap technology stocks, starting to regain the outperformance. If you move over one more to the right, you see equities versus gold, which again, Russell 2000 versus gold. And the reason I like this chart is because gold generally responds to real interest rates. So if real interest rates in the economy come down, basically all assets get a levitation effect from a lower discount rate. So this sort of tries to neutralize for the effect on interest rates. You say, if real interest rates go from 5% to 0, sure, stock prices are going to go up, but are they going up in excess of that decline in interest rates? This chart would suggest that no, they're not. Again, relating it back to that peak in March of 2021.
Right.
So it's a little bit nitpicky using the Russell 2000, and you are certainly correct that the S&P 500 is making a new high. The NASDAQ is making a new high. The Russell 2000, however, is not. And when you relate it to long duration bonds, we're seeing an underperformance of some of these more growth sensitive sectors. So that's sort of how I square this whole picture between growth slowing, the Fed tightening, yield curve flattening. We have some consistent signals if you look under the hood, but you are right that we do see stocks continuing to rise, and anything that's measured against commodities right now, commodities are the real standout because of a lot of the supply chain issues that are causing oil and natural gas to go higher. So that's why you're seeing an outperformance of commodities relative to basically everything.
So that's a really great breakdown, and I'll tell you, for those of us that do follow the markets pretty carefully as far as equities go, the IWM, right, it's been really range bound the entire 2021. I think a lot of people, investors that are fully invested in their 401ks, they might not have seen the jump in gains that you might have seen if you were, more NASDAQ heavy or maybe S&P heavy, so some people are like, wow, I see stock markets that are at all-time highs, yet my portfolio is not doing so well. Exactly. So that which I think it will be interesting to see what happens in the event that we, continue to see, flattening of the curve. So let me ask you this. One last thing. We've got the Fed coming up here, very shortly. And we just had the ECB meet today at the time of filming. Transitory has been the term that the Fed has used to describe inflationary pressures, but it seems that some of the Fed governors are starting to maybe backtrack that a little bit. How do you feel about inflationary pressures now as it stands? And do you think it is going to be persistently higher, or do you think, these supply chain issues are going to come off a little bit, and it's going to ease these pressures? What do you think?
Yeah, Blake, these supply chain issues have definitely persisted longer than I think most of us have anticipated. I think that a lot of the inflation crowd may be spiking the football a little early. We were sold the inflation story as a monetary phenomenon, or, quantitative easing was going to drive the inflation. But really what's going on is just these rolling supply chain shortages going from good to good to good. If we go back 6 months, I don't think anyone was forecasting a shortage of magnesium that was going to impact auto production. A lot of these were very unintended consequences, things that were very difficult to foresee. The one point that I would make, though, is that when you look at, and this is, I guess, a little bit more of a wonky economic concept, but if you look at a supply and demand curve, what we're seeing now is we're seeing an inward shift of the supply curve. The supply curve is shifting inward. And what that's doing is it's cutting the demand curve at a higher price level, right? If you have less supply and constant demand, it's going to cut it at a higher price level. But what it also does is it cuts real GDP at a lower level. So all we're doing right now is we're trading inflation for real growth. So if we were in a 1970s or a situation that was going to be very negative for long durations bond, we'd see an inwardly shifting supply curve and an outwardly shifting demand curve, which would cause higher price level and higher real growth. What we see is the inflation rate is sticking at a higher level than most of us anticipated because these supply chain issues are taking longer to resolve. But every single tick higher in inflation is a tick lower in real growth. We see that in the Atlanta Fed GDP numbers that came down for Q3, and then the report that came out today. I would really love to share just one more chart about the GDP report that just came out.
Please do.
Oops, I'm sorry, I just missed that. 1 second here. Okay, so this is a measure of the economy called real final sales. And the reason that I'm using real final sales rather than real GDP is because real GDP came in below expectations this morning at 2.0%. But 2.1% of that came from inventory building. So that's an inventory over the long run nets to zero. So real final sales is GDP minus inventory. It's basically trying to net out that really volatile factor and just look at what's called real final sales. On the left, you see the quarter over quarter change, and you see that real final sales actually declined in Q3. Yeah. And as a sequential slowdown from Q1 to Q2 to Q3. And on the right-hand side, it's a sort of a 2-quarter smooth growth rate. So we do see that the growth rate is coming down. And if we look under the hood, there was a big drag, a very big drag, admittedly, from a reduction in auto output, which is very, very supply chain concentrated. However, if we look at real residential fixed investment, this is housing. This is basically new housing construction, 2-quarter smooth growth rate, trying to smooth out some of that base effect. We see a very, very precipitous decline in the growth rate of real residential fixed investment. Part of this is because we have supply shortages. It's causing the price level to go up, and the price level has risen across housing and vehicles where it's starting to cause consumers to back off. And we're seeing that in these GDP numbers where the growth rate's coming down across the cyclical sectors. So Moving into Q4, I'd be very, very mindful of looking at residential investment in the housing sector. I'd be looking to see if we get some pickup in this auto production. But we do have a slowdown across all four sectors, and it is being impacted by rising price levels because income is not keeping up with these supply chain issues that are causing higher price levels. So we're seeing a reduction in real income that's translating to a reduction in real growth. But yes, supply chain issues are sticking a little bit longer, but I would say that by the time we get into the middle of next year, I would expect the inflation rate to come down quite a bit.
So what type of environment then, Eric, are we in if we have, slower growth, which may end up being recessionary based on what I'm seeing here in the next couple of quarters, but persistently high inflation? What does that translate to you?
So to me, the way that I would set up is one, I would have higher cash levels than otherwise. I think that we've had pretty significant gains, especially in the broad indexes like the S&P 500. The Federal Reserve is getting ready to do some or scale back their asset purchases. That's going to reduce money supply. Most of this liquidity is going to be coming out of the financial markets rather than the real economy. The Fed also is guiding towards higher policy rates. That's flattening the curve. So one thing is I would have higher cash levels. At least for me, as someone who does more long-only investing, but traders or investors with access to more volatility-type products, I would expect an increase in volatility over the next couple of quarters as the economy slows down and the Fed makes this potential policy mistake. I would also keep some long-duration bonds for some of that safety. And if you are looking in the equity sector, there is a reason why the NASDAQ performs well when growth slows. When growth in the economy evaporates, and there are companies that do have legitimate growth, that growth trades at a premium because it's harder to find. So if you do have any growth, you're going to get a little bit more of a premium than everybody else. So if I was to structure a broad portfolio, I'd hold some long duration bonds. I'd be increasing my cash position. I'd be getting defensive with my equities, and I'd be looking for some volatility over the next couple of quarters.
Eric, you speak a lot of sense to me, and I'm sure to every trader, investor that's actually viewing this right at this moment. So let me ask you this. How do I find out more about you?
You can go to epbmacroresearch.com or follow me on Twitter at EPB Research, or shoot me an email anytime, eric@epbmacroresearch.com.
Well, I'll tell you, every time we get a report here at Traders Summit and we publish it, it's one of the first things that I read in the morning. And I urge you guys and gals to do the same as well. Make sure if you like this video, if you're watching us on YouTube, subscribe to our channel. So this way you always catch Eric's research, his outlooks, and other people that we bring on as well. And make sure you give us a thumbs up. You give Eric a thumbs up. I'm just here I'm just here asking the questions. Give Eric a thumbs up and tell him that you really like this video. So Eric, thank you so much for joining us and sharing your knowledge with the Traders Summit community. I really appreciate you. And I know everybody watching really does as well.
Thank you so much, Blake.
All right. Well, I'll look forward to our next visit here in the next few weeks.
Sounds good.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.